Hello and welcome to our webinar, Avoiding a DOL Audit, or at least being prepared if it happens to you. My name is Julie Dorr and I will be your moderator for today's event. Our presentation will last approximately 40 minutes with the remaining time available for your questions. If at any time you have any questions, go ahead and log in and put them into the dashboard that's over on the right, typically on the right-hand side. Go ahead and log in and put those questions in there. We'll save them and reserve them for the end. Speaking of questions, we were running a poll. It's now closed, it appears. So just disregard that, but thank you for participating, for all of you that did actually participate in that poll question. And while we're looking at the dashboard, please be sure to download today's presentation in the handout section. Again, if you have any problems getting the handouts for today's presentation, just email them to me right now and I will send you that document right away. And then also, just so you know before we get started, this presentation is protected by copyright and all company materials are also protected. We're also recording the entire conversation and our presentation today, so please be noted of that. And this presentation provides general information only and does not constitute legal advice. We recommend that you consult with legal counsel to address your specific situation. So before we get started, I've already jumped ahead on the slide because I'm having a little technical difficulty myself, which Linda already warned me that I would have. I'm going to introduce one of our expert panelists, Marla Merhab Robinson. Marla is with the law firm MRJC, where she is a partner and head of the firm's transactional department. She primarily practices in the areas of corporate, mergers and acquisitions, real estate, finance, and employment law. We also have the infamous people problem solver, Linda Duffy, president of Ethos Human Capital Solutions. Linda works with business owners and executives to provide strategic human resources direction, develop leadership talent, and increase organizational effectiveness. And Linda, I'm having a feeling I should have turned this over to you to do this morning because my cold medicine clearly isn't working.
Yeah, we're still, from my point of view, stuck on the landing page, so I don't know if we can get off of that or not, or if other people are seeing something different, but that's what I'm seeing. Okay. So anyway, well, I'm not going to worry about that, but Cyndi, what are you seeing right now?
I'm seeing the landing page as well.
Okay. So Julie, while you work on that, I will say that I'm very excited today that we're going to have Cyndi LeBerthon presenting with us. Well, at least it changed. There you go. All right. Now we're seeing everything. Cyndi is a CPA, and she's a partner with LTSP, a local CPA firm here. Cyndi is a good friend of mine, and in fact, for those of you that know me and Marla, you know we're both huge Angels fans, and Cyndi is also one. And the last few years, we have taken the opportunity to travel to see them play both at spring training and at different parks around the country. So we're looking forward to a trip next month, or actually in 2 months, to go see them play in Toronto. So that's a little known fact about Cyndi, besides what she does. Cyndi actually has a lot of swag in the field because she is a member of peer review. So she actually has, she goes out and she sort of audits, if you will, or reviews the people doing the reviewing. So she can tell you more about that. But today she's going to be talking to us about how to prepare for 401k audit. So she spends most of her time doing that, going out and helping clients be prepared for them and making sure that they're in compliance so they don't get in trouble with the Department of Labor, and we can all use some of that assistance. So Cyndi, we're going to go ahead and turn this over to you, and we look forward to learning everything we need to know about a 401k audit.
Thank you, Linda. I really appreciate that introduction, and let's hope that our technical difficulties are behind us, even though I am a jinx, so I'm sure we're going to have a few issues. I'm just seeing if I can move forward the slides here. Give us 1 second while it's thinking. So I'm going to make a presumption that everybody on this webinar probably signed up because they have heard all about all the DOL audits and they're concerned about being selected or what's actually going to happen. Now, the purpose of today's webinar, let me just scroll one. that was the agenda. So the purpose of today's webinar is to educate you, not to scare you. But I know sometimes those things are going to be one and the same. And I have heard on many of occasions plan sponsors come to me and say that based on the regulations and the fear of having a DOL audit, they're just done. And they just want to terminate their plan and liquidate it and not have to worry about all these big brother regulations anymore. So before we start, I just wanted to say that please remember that by having a plan for your employees, even if it's just employee money and you're not making an employer contribution into the plan, you are really doing something great for your employees. And yes, I know that there's regulations and oversight over sponsoring a plan, it really is a good thing for your employees because we know how hard it is to get them to enroll into your plan. Can you imagine if you didn't offer a plan and you were expecting them to go out on their own and get their own IRA and take care of their own retirement? It's not going to happen. We know that the likelihood of that's just not going to happen. So if you ever get to that point where you're done with oversight and you don't want to deal with your plan anymore, pick up the phone and give me a call, and I'm going to walk you off that ledge and make you realize again how great of a thing it is that you are doing for your plan. Now, ERISA falls under two masters. You've got the DOL and the IRS. Now, today's focus is going to be primarily on DOL audits, but I did want to briefly discuss the differences between the DOL and the IRS. So, for example, the DOL is concerned with participant discrimination. They want to make sure that you're following all the compliance matters and that you've got proper engagement of your service providers. Where on the other hand, the IRS focuses on areas that's going to generate additional tax revenue, and they do that through the assessment of penalties and interest. So they're looking at areas of potential plan disqualification. So for example, the IRS is looking to see if your plan document is properly drafted, signed, and dated, because we all know if something's not executed, it doesn't exist in their eyes. They want to know if there's an IRS determination letter, if you're an individually design plan, or if there's an opinion letter. They want to know if the discrimination tests have been performed timely, and that if corrective actions were necessary, that those were also made correctly and timely. They're concerned if there's a controlled group or affiliated service group, because that could impact how your discrimination testing is done. And they also want to make sure that all participant notices are made and documented. And we're actually going to talk about those a little bit more in hot topics if we get to there if time allows. They're also concerned with the IRS limits being followed. And so we all know that, for 2005, which are the years that they'll be auditing, they were limited to 18,000, in deferrals and, total of 53,000 in combined contributions. So they'll be looking at that. They're also concerned with the eligibility provisions because, again, that could be a discriminatory factor. They're concerned with partial plan terminations and making sure that you're not favoring those highly compensated employees, which is really easy to do with the smaller plans, especially the plans with under 10. We know that generally those plans are designed because the owners want to put money into a plan, so we just have to make sure that you're really working with a great vendor or ERISA attorney to make sure that your provisions are proper. Whereas for the DOL, their concern, again, is more participant related. So have the 5500s been filed timely? Have you made or distributed the summary plan description and the summary material modifications to all participants when you're supposed to? And we'll talk about that in a little bit. Have you made all the annual and quarterly fee disclosures to your participants? One of the big ones that we've been hearing about for years and is still to this day, one of the first things the DOL brings up to me is have all deferral and loan payments been remitted timely? And of course, have fiduciaries determined that the plan fees are reasonable? You've probably heard that in the news recently. Do you have a fidelity bond, which is different than a fiduciary insurance, but does the plan have a fidelity bond? Is there a process in place to monitor plans service providers? And that would be, do you have an investment advisor or do you have a committee that's monitoring your service providers? Are there prohibited transactions? So that's going to be self-dealing. Are you loaning money to yourself or to the company out of the plan? Situations like that. And the big one is, are your plan provisions being followed? And the areas of most common non-compliance are not following the definition of compensation, not following your vesting provisions, and that could be either for not knowing your vesting provisions or not having the proper participant data in order to be able to calculate that proper vesting. And the administration of participant loans. Are the loans being made according to plan provisions? Are you starting the loan payment withdrawals out of payroll timely? And when a participant leaves or goes on leave of absence, are you making sure that that loan is either paid up or it goes into default status? Now, one thing I didn't mention about myself is that in our audits, this is really a specialty niche, that we work on. So we are out there talking with the DOL and the IRS on a regular basis, not only through the continuing education that we attend several times a year, but we also have no problem just picking up the phone and making those phone calls. And especially as a peer reviewer, as Linda alluded to earlier, I'm charged with making sure the other auditors that are CPAs know what they're doing when they're doing these annual audits of plans. So we're constantly out there trying to hear what they're saying. And what I heard from an ex-DOL investigator, now it's unofficial, although I did get an unofficial confirmation from a current DOL investigator, is that the DOL investigators actually work on a point system. So you may or may not have heard about this, but really it's kind of a quota that you have to meet in order to keep your job. So if the DOL cites any violation, so they're doing the investigation and they cite any violation at all, they get between 20 and 25 points. Now, if they have no findings, so they just go in and they close the case, they get between 3 and 5 points. The minimum that they're required to get on an annual basis is 100 points. However, the average that they really want you to get is 100 points. But what's interesting is if you get 200 points or more, you get to go into the bonus pool at year end. And you also get to be considered for a step increase in pay. So what we have kind of taken from this point system is that, yes, these DOL investigations happen. If we've got an investigator that's out there and is just digging into your plan and won't go away, we're going to find something to throw them a bone. We're going to do a small monetary compensation correction, make them go away so that they get their 20 to 25 points, and you get back to work into your normal daily routine. Now, you cannot completely avoid a DOL examination, but you can reduce your chances by knowing who is being selected by the DOL. And there are a number of reasons that the DOL may select a particular plan to audit. Participant complaints to the DOL, or the Office of Participant Education, which is one of their divisions, is the primary reason for a DOL investigation. We've also got the IRS or SEC referrals, so any other regulators can refer you. Or you could be targeted as part of a national enforcement project. Or you could be selected just based on the information that you have on your annual Form 5500 filing. There's those compliance questions, so we'll talk about those. But simple questions, how you answer those questions on that form could trigger a DOL audit. Now, the DOL has stated that there are no random examinations or audits other than the review of CPA audit work papers. So you really can reduce your chances of being selected just by knowing what it is that they're looking for and taking actions to prevent those triggers. I do know we've got a few people on the webinar that are with larger plans, and they have to endure CPA audits every year in addition to the DOL audit risk. So we'll talk about that really briefly in just a few minutes as far as how the review of CPA auditor work papers impacts you. So as I mentioned, participant complaints are the top reasons for DOL examinations. And the Office of Participant Education is responsible for helping participants resolve complaints against the service provider or plan fiduciary. In most cases, these are resolved timely, and it just goes away. It's usually just a miscommunication. But in other cases, if it escalates, if it's drawn out, if the DOL isn't getting a response from the plan sponsor, then they'll go ahead and just refer it over to the DOL Office of Enforcement. And what we have heard from the DOL in relating to this department is that your participants or their beneficiaries will contact the DOL when you're not responding to their inquiries or concerns. So the one thing we always want to say is always, always, always respond to your participant inquiry timely. No matter how trivial it may seem to you. Some of the top complaints refer to deferrals not getting into their accounts promptly right after payroll, or they want a distribution but cannot get a call back and they don't know what they're supposed to do in order to get their money out of the plan. Or, more common, they completed the paperwork wrong. So there's a delay. They submitted the paperwork, they thought they were getting a distribution, their paperwork was done wrong, and they don't understand what's going on. Maybe they missed that phone call or threw that piece of paper away where you sent something saying, hey, we need to get this completed, you forgot to get this notarized. So whenever there's situations where they feel like they can't get their money, they're concerned, and they could call the DOL for that. A couple other things are, if you've got investment losses, we've had a couple rocky years in these plans. All the plans I'm seeing for 2015 have either very little income or experienced an average net loss for the year. That makes participants a little nervous, a little antsy. Or fees. So fees have been in the media a lot lately, especially as it relates to plans. And the way that plans can be set up, some fees are just right on the face of your statement. You're paying $20 a year for record-keeping fees. Other plans bury those fees in the net appreciation or net depreciation of those investments. So what we're hearing from participants and from the DOL is that people are getting smart. They're seeing this in the news and they're saying, well, I wonder what I'm paying. So they pull out their statement and they pull out their spouse's statement and they go, well, wait a minute, I'm charged $20. My wife is not charged anything, so I must be paying too much and that's a problem and I'm not going to tolerate it. So education of your participants is crucial. We talked about participant notices, fee disclosures, which came out a few years ago. I'm sure everybody's doing all your 404A5 disclosures. So really communication and education to your participants is key. There's also been in the news a lot of lawsuits recently by the DOL, by participants, class action suits against plans because of fee or shared class, and that all ties back into fees. Those have historically been really large plans, and so I've heard a lot of sponsors say, it's not my concern, I don't live in that space, but know that just 3 weeks ago, there was a class action suit brought up against a $9 million plan. So it is trickling down, and I could see it trickling down even further. So making sure that you've got all your processes covered is going to be critical. We also have, IRS or SEC referrals. So if you've got, your company has an income tax audit going on, or let's say it's a payroll tax issue, anytime you're working with a government agency and they suspect that there might be anything going on with your plan, they're going to refer you over to the Office of Enforcement just to make sure that everything's going good. They're not going to be the ones that look at your plan, but they're going to quickly refer you over. So the national enforcement projects are really, other than participant complaints and a few key targeting areas, this is where they take a look and get the majority of their cases. So major case enforcement deals with large plans. Now, large plans technically is defined as any plan that has 100 or more participants, whether they're in the plan or not, if they're eligible. That kind of defines a large plan. Now, in this case, they're really talking about, for lack of a better word, the humongous plans. The plans that are 500 million and up, because they get more bang for the buck if they go after a large plan and they have issues, they get corrections. They look at kind of like a sampling. If I've got X dollars in all the plans and I'm getting these few huge plans, we're good. And in 2016, the DOL has stated that they're going to remain dedicated to strategically focusing more resources on these. So that's good news for the smaller plans, but know that you're still at risk. It's not taking 100% of their effort yet. We also have the Employee Contribution Initiative. And this is focusing on delinquent employee contributions and loan payments. So I've already mentioned it a couple of times, and you're going to hear it just a few more times. It's been a concern that money is being withheld from payroll for your participants, be it loan payments or deferrals, and not being remitted to the plan on time. We've got some safe harbors, which we're going to go over, and there's going to be some procedures that you have to do if you're a large plan. But this is the initiative that's going after those plans. Now, they get some of those answers on your 5500s or audit reports, or they get it from participant complaints. We also have the plan investment conflicts. project, and that's one of their newer enforcement projects. And this focuses on the receipt of improper or undisclosed compensation by an employee or received by an employee benefit plan consultant or investment advisors. And it also focuses on ensuring that as a plan sponsor, you are receiving the notifications you need to get from those service providers and that you are responsible for sending out those annual disclosures to your participants. We know that in practice, those are generally outsourced to your service providers to get to your participants, but just remember, you can always outsource your duties, but you cannot outsource your fiduciary duties. So you have to make sure that it actually goes out to your participants. Another national enforcement project is the Contributory Plans Criminal Project, and this is targeted to persons who commit fraud and abuse. So I'm not going to go into a lot of it because I know it doesn't impact anybody on this webinar. But one thing I do want everybody to know is that ERISA has granted the Department of Labor broad authority with respect to enforcement of regulations governing employee benefit plans, and that includes serving administrative subpoenas for books and records of the parties. And under ERISA, the DOL can bring civil action in federal court and allows them to assess a 20% civil penalty on all monetary settlements with the agency. And we'll talk about this just a little bit later. They can also impose criminal sanctions for an individual, you can have imprisonment up to 10 years and a fine of $100,000. And for companies, the maximum sanction is $500,000. During 2014, the DOL closed over 3,900 civil investigations, of which almost 65% resulted in monetary results. So those are those investigators that got 20 to 25 points on all of those. In addition, they filed 107 civil lawsuits and closed 365 criminal investigations, which led to the indictment of 106 individuals. So it's something to take serious, not something to always be scared about if you're following your proper procedures, but something to know that's happening out there. Another way that you could be targeted is by the answers on your 5500 or your 5500 itself. So if your 5500 is not filed timely, or if it's not filed with all the required attachments, so for a large plan over 100, you have to have audited financial statements attached. If it's not done timely, this gives the DOL a reason to take a look at your plan. If you report significant drop in participant accounts, the DOL is concerned about partial plan terminations. And this is because when a partial plan termination occurs, all impacted participants become fully vested in their employer contributions. So that vesting schedule you have goes out the window for those impacted participants. The DOL knows that small plans who may or may not necessarily have great consultants around them don't necessarily know or follow this regulation, so it's an easy target for them. So a general rule of thumb is if you have a 20% reduction in workforce, this results in a partial plan termination for the plan. And it doesn't have to be just in a one-year period. They take facts and circumstances over the reason behind the reduction in workforce. So if there's any concern, I definitely recommend that you discuss it with an ERISA attorney to see if your plan experienced a partial plan termination. Now, if the 5500 has erroneous or misleading information, so for example, a large amount of assets classified as other on a large plan, that is an option, and we see that way too frequently. Or in a small plan, your 5500 allows different categories like real estate and loans. So if you have a large percentage of assets in there, usually it's by mistake because you might have a real estate trust, which should be up actually in a mutual fund, and it's down in real estate. That's of concern to the DOL because those are not easily and readily tradable investments for those participants. We also have some compliance questions, which we're going to get to on the next slide. And then, as I alluded to earlier, a deficient or missing auditor's report. So if the auditor's report and financial statements are not attached to the 5500, we've got an issue there. Your 5500 is going to be rejected immediately. If the auditor's report and financial statements are deficient, now again, I'm only talking about the large plans that have the joy of going through an annual audit with CPAs like me. If that report is deficient, the DOL is going to target that and pull that and start an audit of the plan and of the auditor. And it's really easy for the DOL to identify an audit that hasn't been performed under professional standards. One of the quickest ways is they're expecting, maybe depending on your plan, 15 pages of note disclosures, and we see 4. It's really easy to see that that auditor may not be competent under ERISA and DOL regulations. And the problem with that is if that audit gets rejected, as a plan sponsor, you now become the victim because your 5500 is now rejected as well. And you get a nice little 45-day letter saying that you've got 45 days to get a new audit completed to the DOL's satisfaction, or you're going to be assessed a civil penalty. Okay, talk about that technical glitch there. All right, so this is one of those, this is the compliance questions that's on your 5500. And there are 2 that lead to the most DOL inquiries and ultimately into examinations. The first one is if there was any late remittances. See how this keeps coming back? So ask if there was a failure to transmit any plan participant contributions within the time period described. The other one is, and I think it might be on the wrong line, is was the plan covered by a fidelity bond? So if you are a small plan under 100 participants, for remitting your contributions, you have a safe harbor of 7 business days. So as long as you get everything remitted from the day that payroll was paid within 7 days into the plan, you're golden. Large plans, on the other hand, don't have a safe harbor. And what is determined as soon as administratively possible is based on your processes and your precedent. So if you historically remit your contributions to your plan within 1 or 2 days of payroll being paid, and then suddenly you do it within 7 days, DOL could consider that late. And the argument of, well, small plans have that as a safe harbor doesn't fly when you're a large plan. They expect that in a large plan, you've got backup procedures, you've got more controls in place to ensure that everything's being done timely. And interesting to note is that the DOL and the IRS, but the DOL, they're smart. They read the news, they watch TV, they see what's going on with the companies. So if you're a company that's on the news because you're doing some significant layoffs, you're closing some divisions, you're closing some retail stores, they're going to go back and say, you know what, I'm not waiting to see what they answer on the 5500 as far as the reduction in participant counts. I know that they're doing all these reductions, and that sounds to me like they may have a partial plan termination. They're actually going to get out there in front of it before the 5500 is filed because they want to make sure that you get it corrected sooner. So if you're in the news for whatever reason, just know that if you've got a plan, you could be the next target. Now, we mentioned the review of CPA auditors' work papers for large plans. The DOL is definitely focusing on improving the quality of employee benefit plans that are done by independent auditors. And while the focus is on the auditor, if they see any compliance issues within the auditor's work papers, based on our testing, it could lead to the plan being selected for further examination. Now, this is small. I don't expect you to be able to read it. I threw a couple of these notices in here. This is for large plans only. If you get a notice that looks like this, that is asking you to contact your auditor, they call us IQPAs, Independent Qualified Plan Auditors, you want to make sure that you get this to your CPA quickly. This means that they have selected your plan in order to look at the auditor's work papers. However, they only give the auditors about 10 days to get everything over to the DOL, and there are certain requirements that we have to follow, such as going in and redacting all personal information, such as Social Security numbers, date of birth, date of hire. So it takes a bit of time for your auditor to comply with this request. And if we don't get it over there in timely, it could, in some instances, trigger an automatic rejection of your 5500. So please don't receive this and think, oh, this has to do with my CPA. I'll get over to them in a couple days. I know they're paperless. They're just going to upload it. So no worry. The DOL doesn't give us extensions. They don't care if the partner you're dealing with is on vacation. They expect all of these results in 10 days. So if you see this, get it over to your CPA. So what can you expect if you are selected for DOL audit? This is what the initial request list looks like. As you can see, very small font. I don't expect you to read it. However, I wanted you to see the volume of what they're requesting. And so usually they'll send you this initial request, you submit everything, and they're going to send follow-up questions. So this is just your initial request. They give you 20 calendar days to provide all this information. So you think about what you're doing. Do you have an extra 8 hours in every week just to sit down and gather all this information so you can get it over to the DOL in 3 weeks? I know I don't. So being prepared is really key. And we'll go through what you can do in order to prepare it. But one thing I did want to talk about is when you are supplying all of this information to the DOL that they're requesting, we really suggest that you give them a roadmap, meaning put everything in a 3-ring binder, have it indexed consistent with the numbering and lettering system that's on your DOL audit request. Tag things. So if you've got one page that's in a 20-page document and that addresses what you need to give them, you tag that, you flag it for them. You want to give them the appearance of how organized and prepared you are, because they're going to get the impression that all of those controls relate to how you're running your plan as well. So after you provide all of those documents and you go back and forth with additional requests that they're asking, they're going to schedule an on-site interview. And we really stress that you want to have a single point person within management for when you're going through an on-site interview. And we know that you don't want to answer something you're unsure of. And if it's not in your department, you may not necessarily be comfortable answering a question. So we have seen where companies have a roundtable for the DOL, someone from payroll, someone from benefits, someone from accounting. You really don't want to do that unless it's absolutely necessary, because you could have some conflicting questions. Because remember, they could have follow-up questions individually with somebody. So if they're concerned about something, they might go to John and ask him a question, go to Susie and ask a question independently and compare the answers. So you really want to just have a single point person. And if you don't know the answer, you can just say, you know what, I'm going to check with you and get back. You are allowed to have your consultants there. We recommend, if you work with an ERISA attorney, the first thing you do when you get that initial request list that I showed you is you contact your ERISA attorney. Let them know what's going on. They're going to then be the intermediary to get the documents and everything to the DOL and schedule the on-site interview. You still have to be involved in that, but they will take charge and kind of orchestrate everything. You also want to let the other parties know that you work with. So if you've got a CPA auditor in your large plan, let them know immediately. If you're a smaller plan and you've got a third-party administrator, you want to let them know. It takes some coordination to get everything going, and you want everybody kind of on call when this on-site interview is going on so that they're there to answer questions for you so that you can then get back to the DOL investigator. And then after you do all that, be prepared to wait. Some examinations take 6 months to 2 years before they're resolved. And oftentimes, after you get to this point where you've given them all the documents, you've had your on-site interviews, they've had some follow-up questions, they go radio silent. You may not hear anything for over a year before you get your closing letter. And that is the final phase of an examination. It's the resolution of the investigation. And the DOL can issue 3 different types of letters to close out the examination. A favorable letter just says, no action taken, you're golden, you're done. And then a voluntary compliance notice, which sounds great, but in actuality, it's just talking about, we found an ERISA compliance matter. We think you should voluntarily correct this, because if you don't, it's going to go to litigation. So you'll definitely want to voluntarily correct anything that they find. And of course, a litigation letter, which says that the matter is going to be referred to the solicitors of labor for litigation, which you don't want to do. So how do you prepare? Obviously, a DOL examination is serious. We talked about the penalties that can be assessed, and they shouldn't be taken lightly. And you really should be able to produce detailed documents relating to your plan at a drop of a hat. You really should be able to have all of these at your fingertips. So we're going to talk about some best practices that you should consider implementing now before you're faced with a DOL examination. And this is also helpful to have if you're going to undergo your first CPA audit. So you're a smaller plan in growth mode. Let's say you're 80, 90 employees, participants, but you're in growth mode. So you know that in the next year or two, you're going to have undergo your first CPA audit. What a lot of smaller plans don't realize that first year of that CPA audit, we have to go back a minimum of 3 years and look at plan transactions and reports and records. And then depending on what we find, we may have to go back, 7 years. So having everything in a central place and having it organized is really key for a CPA or a DOL audit. So the first thing that you should do is set up a perm file. And this can be a paper file, or it could be a paperless file and saved on your network. But it's important that you have all of these items saved within your perm file. Remember that plan documents and amendments must be signed. If they're not signed, you could be in compliance issues because they're going to consider it that it wasn't executed, or that amendment wasn't made timely when it was required to, so you could get yourself in trouble. So make sure everything is signed. You need to have a copy of your termination letter or opinion letter. You want to make sure you have signed copies of all your service provider agreements. And what I have seen, unfortunately, is that sometimes plan sponsors don't keep copies of those or the executed version because they know that the service provider keeps those on this website or in their files. But then they change service providers. And lo and behold, whether they're now going under a CPA audit or a DOL audit, it's 3 years from now. Those records are gone. That service provider you're no longer contracted under, it becomes very difficult to get those. You usually can, but we've seen how quick of a timing schedule you're on when you have to provide this information. So best practice, have a copy of your all service provider agreements in your perm file and just make sure they're signed and executed. If you have an investment policy statement, you want to make sure you've got a copy of it in your perm file and include in the perm file your evidence of complying with that investment policy statement. So this would be the minutes of any meetings and reports from investment advisors or investment committee that you may have formed, showing the analysis of investment elections, share classes, fee ratios, etc. And the last thing that's on this page is a narrative of processes and controls. And this is actually something I've started to see the DOL request on a more frequent basis, historically on the larger plans, but now I've seen it on the smaller plans as well. The DOL wants to know that you have processes in place to follow your plan provisions and to follow ERISA. So a detailed narrative of such processes and controls is critical. You want to be very detailed. You want to use positions and not names. So for example, the payroll manager does XYZ in order to show the processes that you have. And you want to cover everything from the onboarding of a new employee, because that impacts your participant data with the hire date and such, to salary changes, how payroll is processed and approved, the reconciliation and remittance of contributions, to plan activities such as distributions, loans, rollovers, deferral changes, investment election changes, who has control over that and who monitors all that information. You want to document your process for reviewing the service provider's reports, compensations, and services. And usually for this narrative of processes and controls, it's usually a 3 or 4 page small font description. And I am happy to share with any of you the template that I give my employee or my clients. So if you email me or call me later, I'd be happy to share that with you. It kind of gives you a starting point that you can then customize for yourself. So you've got your perm file. Now you're going to set up an annual file. And in each annual file, you're going to want to keep a remittance schedule. And I can also share a template of this if you'd like. And this is usually an Excel schedule that documents data payroll, what your contributions and loan payments were, and the date you remitted it to your plan or custodian. What's great about having this done on an ongoing basis for each payroll is at any point in time you can validate it back to your year-to-date payroll totals to make sure we didn't miss a manual check run or an adjustment run. And if there's any reason why those contributions were not remitted when they usually are, you can document down there at that time. Because if you're going through a DOL audit today, they're going to be looking at 3 years ago. And so remembering that, oh, we had a power outage and we couldn't get in to transfer the funds on such and such date, there's no way we're going to remember. So this is a great source in order to be able to support why your supposedly delinquent contributions are not delinquent. And I do caution, especially on the smaller plans, you cannot use that Sally was on vacation or that Joe wasn't there to sign the check as a reason for contributions being late. You have to have a backup system. The DOL looks at it just like they look at payroll taxes, and payroll has to be done on time. Also want to have your year-end payroll reports and a copy of your W-3, and this would be at the employee level as well as company totals, and you want to make sure that you reconcile that back to the custodian statements. You want to have copies of your discrimination testing and any corrections that were made if applicable. A copy of your 5500 and the acceptance that you get from the online filing system. The Form 8955 SSA, which is a form where you report those employees that have left your employment that still have money in the plan. This goes to the Social Security Administration. Make sure you have a copy of that. One that you may not have heard too much about is the Custodian SOC 1 report, so I'll get back to that in just a minute. But also, while we're on this slide, I want to talk about fidelity bond. So we talked about the fidelity bond earlier. You must have it, must be 10% of beginning net assets, needs to be in the plan's name. Back to the Custodian SOC 1 report. This is a report on the internal controls of your service provider. So John Hancock, Fidelity, Principal, whoever it might be. And I know that you might not be familiar with it. It's generally provided once a year. Now for your payroll providers, it's usually provided twice a year. And the DOL is concerned with sponsors relying on the custodians or payroll providers and not really evaluating their controls to make sure that they can rely on them. So as I mentioned earlier, you can outsource your functions, but you can outsource your fiduciary responsibilities. And that is just the motto of the DOL. So best practice is to obtain this report for your annual files. And it's lengthy, I'm not going to lie to you. It could be 100, 200 pages depending on who you're with. You don't need to read all of it. You're going to flip through to that one section that talks about the controls and the tests, and it's going to be in a tabular form. And you're just going to skim the pages down the right side of each page, and it's going to keep saying no exception noted, no exception noted. That's the results of the test. When you get to one where there's exceptions noted, it's going to be quite lengthy. It's going to stand out like a sore thumb. You're going to want to look at those and see if that causes you any pause. If you're concerned about anything that you see in that report, you're going to want to comment on it and why it doesn't relate to your plan. So what we recommend for all of our clients is that not only do you have a copy of the SOC 1 report, but you also attach a memo saying that on such and such a date you reviewed it, you didn't note any exceptions that relate to your plan, and that it appears that all controls are in place. The DOL loves seeing that. They know that when they see that, you're really taking your fiduciary responsibilities to heart and that you're following what needs to be done. Also, in your annual files, you want to keep a copy of all of these forms. So open enrollment, service provider fees, participant fee disclosures, and all other notices. You're aware of those, your providers provide them to you, but you need to make sure you keep copies. You also want to perform a detailed self-review of the most common errors in compliance. So wrong compensation, late remittances, vesting provisions, defaulted loans, and accurate participant data. Now, let me just go back to this for just a minute. So for wrong compensation, what we're seeing most frequently is that bonuses or manual checks are either improperly excluded or firm bonuses might be improperly included. So you really want to take a look at what your plan document says. Late remittances, we hit on that so many times. If you still have a question, pick up the phone, give me a call. Vesting provisions are usually due to inaccurate participant data. Date of hire is a big one, especially when we've got rehires or a lot of turnover in our activity. Defaulted loans, who is monitoring? Usually a loan is defaulted in the quarter after the quarter in which the initial payment was missed. So I know that sounds confusing, but if somebody misses their loan payment in this quarter, then next quarter you're going to want to make sure that that loan gets defaulted. And eventually it'll get deemed, it will be reported as a taxable event to your participant. And then accurate participant data is really the key to your whole plan. If you don't have accurate participant data, there's no way that you could accurately determine eligibility, minimum required distributions, of course, vesting. You know, those are all attributes that relate back to accurate participant data. And I recommend a self-review, even if you have an annual CPA auditor, because remember, everything's done via sampling selection. So we're not testing 100%, and we wouldn't expect you to test 100% either. But every once in a while, especially if you have any changes in payroll, any changes in personnel, you'd want to take that opportunity to just go back and say, okay, am I really following my plan document? Has there been a new amendment I forgot to communicate to payroll, which happens frequently? Or, you know, hey, that new software, I'm still with ABC payroll provider, but we went online. So is everything working right? So you almost want to do a mini audit and put that results that you did it, and if you had any findings or corrections that you made, and throw that into your annual file. And I think we have just a couple minutes to go over the hot topics before we open up for Q&A. So I'm just going to touch on these really briefly, and we'll kind of end our session there. If you're tired of hearing about remittance timeliness, believe me, I'm tired of speaking about it. But it's out there, and it's the first thing the DOL says to us is, did you make sure that they are committing those contributions timely? Small plans, 7 days. Large plans, make a process and stick to it. 1, 2, 3 days, whatever it might be, stick to that process. Participant communications, we talked about this just a little bit earlier. So real quick, you know, your summary plan description must be provided within 90 days of initial eligibility and updated every 5 years if there's an amendment, 10 years if there's not. But what's interesting that a lot of people don't know is that failure to do this and provide it does result in penalties, up to $1,100 per day to the DOL, $110 per day to participants. The summary material modification, anytime an amendment changes that SPD, you have to distribute a summary of material modifications within 210 days of the effective date of the amendment. Once you file your 5500, you are provided with a summary annual report that is generated from the information in that 5500. You must distribute that to all your participants within 60 days of filing your 5500. Penalty for that, $110. And then blackout periods is huge. So if you've got anything that you're doing within your plan that's going to cause your participants to not have access to make changes for more than 3 business days, you have to distribute blackout notices. And there's many, many more notices. So, you know, consult with your administrator or your risk attorney or your CPA, and we'll make sure you've got a list of all of those. Fees, I mentioned a couple of times, it's in the news. Monitoring and levelization is really the new hot topic, and fiduciary responsibility to monitor fees, even those fees that you don't see that are embedded in your net appreciation, comes back to the plan sponsor. And so you've got fees like 12B1 fees or sub-TA fees that an investment advisor can spend 5 hours talking to you about that are embedded within the fee ratios of the fees in the investments that are in your plan. And what's happening is that based on the type of investments that are in your plan, one investment has more fee expense than another one, even though you don't see them. So like a money market has a very low fee ratio, whereas a certain mutual fund might have a very high ratio. So the concern from the DOL's perspective is that if Johnny's got all his money in the money market fund, he's not paying much to cover the record keeping of that plan, whereas when Jim has all his money in that mutual fund, he's paying all of the fees for the record keeping of the plan. So there should be some sort of levelization because it doesn't cost more to administer the plan based on the type of investment that's in there. So a lot of the advisors and the custodians now are going into a method of levelizing, and there's many different ways that can be done. Don't have time to go into detail today, but there's different ways that you can look at it to make sure everybody's being treated fairly on that. And if you've got extra money that comes out of this levelization, it gets put into an IRS account. So if you make an agreement with your custodian that they're going to charge you $10,000 and you're getting more out of these expense ratios, it goes into IRS accounts. And the concern with these is that you understand that they're to be used for plan-related fees, and anything that doesn't get used gets allocated back to all your participants on a pro rata or per capita basis. And the newest issue that came out is the fiduciary conflict of interest. And this requires the investment advisors to act in the best interest to participants and not to make investment selections based on compensation that they receive for such investments. Imagine that. You've got to do what's right for the participants, not what's right for your pocketbook. It also expands the definition of fiduciary, so you're going to see a lot more disclosures coming out from the service providers that you use. And it states that you cannot receive unreasonable compensation. And they don't define what unreasonable is, but really Plan A and Plan B, if they're exactly alike, look alike, walk alike, talk alike, they really should have the same compensation paid to those consultants. And with that, I think I need to turn it over.
Thanks, Cyndi. Wow, okay, you are truly a 401k geek at heart, which I love because you just gave us so much information in the last few minutes. So I know that we're coming up on 12 o'clock, but we've got 8 or so minutes to ask some questions, and I know that some people have already been typing questions in. So on your dashboard, usually on the right-hand side of your screen, you'll notice a section there that says questions. Go ahead and type your question in there, and Julie's monitoring those, and she'll get back on the line in just a second to ask those questions of Cyndi. And then if for some reason today your question does not get answered, I'm sure Cyndi would welcome an email or a call from you just to answer a quick question. So Cyndi, thank you so much for that. And one question I had for you before I talk about the FLSA audit that's on the screen right now is just tell us, I just want to make sure I'm clear about this. So you're going to work with clients of any size, right? So it doesn't matter how many employees they have or how large their plan is in terms of assets?
So a plan requires a CPA to be involved to audit their plan if they have more than 100 eligible participants. And that doesn't mean that all of those participants are actually in the plan. It means that they're eligible to participate. Plans smaller than that are not going to usually be working with a CPA. They're going to be working with a third-party administrator who kind of administers the plan operations and makes all the filings for them. But once you get over that 100 point, then you have the pleasure of working with a lovely auditor like me.
All right, perfect. And if let's say somebody had LTSP for their CPA to help them with their regular financials and everything, can you also do the plan audit, or is there a conflict of interest?
There is not. There are certain requirements that we have to follow for our independence, but there is an exclusion where if we audit or do tax work or do reviews of the company's financial information or any consulting, as long as we are not making any of the determination on an employer contribution, how much is being funded, or doing that calculation of how much is being funded, as long as we're not doing that, we are still allowed to audit the plan.
Got it. Okay, great. Okay, well, thank you again so much for joining us today, and just stay right there because I know Julie, I have a couple of questions. I want to let everybody know this is actually going to be the topic for next month's audit, but also one of the things that we're doing at Ethos is helping our clients by conducting an FLSA audit. People probably heard recently that the federal salary threshold for exempt status is going to jump up to $47,476 effective December 1st. This is actually the first time in my career that the federal standard for exemption from overtime is higher than California's level. So, you know, you need to take a look and be prepared for this. You've got a few months to get all set up, but if you've got employees that are not making a salary of $47,476, then you're going to have some decisions to make about what to do about it. And this is just a really good time to take a look at those employees to make sure they qualify based on the duties test as well. So if you're interested in having us come out and help you with that, just let me know. We're going to help you audit, determine the best strategy for compliance, and then help you implement that. And with that, I'm going to turn it back over to Julie. And Julie, if you could take the last couple minutes and ask Cyndi the questions, that would be great.
Absolutely. Again, thank you very much, Cyndi. That was a great presentation. I'm going to whip through these rather quickly. Again, you can certainly log in your questions, and we got a lot of them. So I'm going to go through and ask Diane first. Can you define what control group or affiliated service group means?
Yeah, so it's a very complicated instance, and you have to really go through and look at the ownership structure of all the employees, all the employers that are involved. But basically, if you have any sort of common ownership with other companies, whether it be a majority or a minority ownership within those companies, you really want to get involved with an ERISA attorney, because they have to go through and look at all the legal structure, how everything's defined, how everything's actually ran, and it's a process that takes, you know, quite a length of time. So I don't have time to go through it all right now, and I would definitely refer you to an ERISA attorney anyway.
Okay, and Diane had another just real quick question here. What is the compliant compensation definition? Does that also need to be referred to an ERISA attorney?
Compliance compensation?
Yeah, compliant compensation.
Well, there's consultants, yeah, I'm not sure, compliance compensation. So compensation to your service providers, you know, I talked about it being reasonable and unreasonable. And, you know, there is no definition of that. It's a facts and circumstance analysis. I'm not sure her reference to compliance compensation.
Okay, so Diane, if you wouldn't mind, just feel free to email Cyndi directly, and you probably have some referrals for an ERISA attorney as well. Eric has a question. The requirements that you were covering in your presentation, do they apply to simple IRA plans?
Not all of them. As far as having your plan documents and having your ducks in a row as far as those, yes, those are still fall under simple IRA. I'll be honest with you, Eric, the simple IRA plans are not really on DOL's radars right now. It's something that they've talked about as far as an initiative looking out in the next couple of years, but they know that there's a lot less risk in those plans right now, so they're really focusing on the other DOL auditors, or the DOL plans. So if that's what you've got, you can breathe just a little bit easier right now.
Okay. And Lisa has a question. Does the DOL go back 3 years or just 1 year?
Generally, it's 3 years. So they'll, if you were to get a notice right now, they're going to be looking at 2012 to 2015, because 2015 is your most complete year. It's very rare that they start looking at stuff within 16 unless it's because of something like you've got a reduction in workforce, and they're going to want to look at your current activity and how those are being processed, but they do always pull 3 years. Now, within those 3 years, they will target certain, they're going to ask for everything for a 3-year period, but they might only look at a couple quarters of payroll spread out over those 3 years, and if everything looks good, they might just stop there. If they find things, they're going to actually expand everything to the full 3 years. Okay, great. Unfortunately, folks, that is all the time we have for our webinar today. We really certainly appreciate you joining us. Cyndi, thank you so much for a great presentation. Linda, did you want to close us out here and talk about the next webinar?
Yeah, absolutely. So as I mentioned a second ago, really one of the big hot topics in our arena this year is this FLSA overtime change. So that's what our topic's going to be next month. Marla will be back online with us, and we'll be talking about what to do to prepare for that change that's going to be effective December 1st. So that's going to be on July 21st at 11 a.m. The registration is right there, so feel free to click on that in the slide and enroll right now. Feel free to tell your friends and family and colleagues about it, because it is going to be a hot topic. And again, Cyndi's contact information is in this presentation. For those of you that didn't catch it earlier, you can download that handout to the right. We will also, assuming this recorded correctly, putting it up on our YouTube channels. Mine is Ethos HCS, so you can go there and see all of our past recordings and have access to it in case you want to refresh anything. Cyndi, once again, thank you so much for doing this. Really appreciate you sharing your expertise with us. And on behalf of all 4 of us today, Julie, Marla, me, and Cyndi, we wish you a great rest of the week.